Welcome to this explainer. Okay, today we're unpacking a massive, and I mean massive, global financial mystery. We're going to dive into why the absolute biggest risk to the United States economy right now is something you've probably never even heard of. It's literally hiding in plain sight. If you've been sitting there wondering why financial markets just seem to occasionally lose their minds, well, you are in the exact right place. Think about it. Right now, almost everyone is doom scrolling. We look at our feeds, we read the news, and we're constantly wondering, why do mortgage rates just refuse to fall back down? Or why do financial conditions still feel so incredibly tight, even when the Federal Reserve is talking about cutting rates? We really need to take a step back and ask, what is the true underlying threat driving all of this? You know, the assumed threats dominating all the headlines, whether it's an AI bubble popping or the latest political drama in Washington, they're actually missing the mark entirely. The danger was never really those things. The real threat, the actual giant lever moving the global markets, originates thousands of miles away, over in Tokyo. Specifically, we are talking about Japanese government bonds. Now, I know, on the surface, this sounds like the absolute most boring asset on planet Earth. But beneath the surface, these bonds have secretly been the financial duct tape quietly holding the entire global financial system together for the past 30 years. But guess what? That duct tape is finally starting to peel. And to understand why this peeling duct tape matters so much to your wallet, we have to look at the backstory. Which brings us to part 1, Japan's lost decades. So after a massive real estate and equities crash back in 1992, Japan essentially hit an economic pause button. To try and fix it, the Bank of Japan cut interest rates to 0. Then they actually went below 0, and eventually they introduced this desperate measure called yield curve control. For literally decades, nothing really changed until 2024. Now, yield curve control. It kind of sounds like a Marvel villain, doesn't it? But in reality, it simply meant the Japanese government stepped in and superglued interest rates to the floor. They explicitly capped long-term bond yields, forcing their domestic yields to sit basically at 0, regardless of whether the market liked it or not. And this created a massive dilemma for big money in Japan. Because domestic bonds paid absolutely nothing, Japanese life insurers, banks, and pension funds had to go on a huge global shopping spree just to get any sort of return on their cash. By sending all that capital overseas to buy up foreign assets, they effectively turned Japan into the world's ATM. And that perfectly sets up part 2, the yen carry trade. This incredible outflow of capital created the core mechanism we know as the yen carry trade. Let's look at how a hypothetical investor, let's just call him Bob, does this. So Bob borrows money in Japan, in yen, at near 0% interest. He then converts that yen into US dollars, buys US assets like treasuries that are yielding, say, 4%, and he simply pockets the free money spread in between. I mean, it was a complete no-brainer. But here's the crazy part. It wasn't just Bob doing this. This trade surged into the trillions of dollars. When borrowing costs are practically 0, investors don't just buy safe, boring treasuries. No, they buy tech stocks, they buy real estate, they buy into emerging markets. Basically, for a very long time, global markets were running on free Japanese Wi-Fi. Which leads us directly to part 3, the 2024 rate shock. You see, this massive global setup relied on one incredibly fragile assumption. The Japanese yields would stay near 0 forever. And unfortunately for the markets, forever came to a screeching halt. That brings us to a frankly staggering number, 17. Because in 2024, the Bank of Japan broke a 17-year streak. They ended their yield curve control policy and actually raised interest rates, not just once, but twice. That foundational assumption of forever 0 rates was totally shattered. The shockwaves from that single decision were immediate, and man, they were brutal. Following the rate hike, the S&P 500 dropped by 6%, and Japan's Nikkei index plummeted by over 12% in a single day. Let me put that in perspective. That was its worst drop since 1987. The global markets were officially spooked. So why did markets freak out so badly? Well, suddenly, borrowing in yen and hedging against currency risk became really expensive. The free money trade just wasn't free anymore. The math flipped. And when the math flips, the capital flows flip right along with it. All that money began flooding back into Japan in a massive unwinding process called repatriation. All right, let's look at part 4, the domino effect. So how does this super obscure shift in Tokyo actually impact you in America? To understand this domino effect, we turn to the legendary investor, Ray Dalio. He points out that the bond market is the absolute backbone of all markets. It literally determines the returns for every single asset class. If the supply and demand picture for bonds breaks down, well, everything else is going to follow. And this leads to a massive disconnect in how we talk about finance. The media treats Federal Reserve Chair Jerome Powell's short-term rate cuts like a highly anticipated GTA 6 trailer drop. But the economic reality? The Fed only controls short-term rates. Long-term yields, the ones that actually matter to everyday life, are driven by global supply and demand. And this is exactly where it gets scary. The United States runs trillion-dollar deficits annually, meaning the Treasury has to issue a massive amount of debt just to keep the lights on. For decades, Japan was a key, price-insensitive buyer eagerly absorbing that debt. If they stop buying, long-term yields absolutely must stay elevated just to attract new buyers, and that creates a steepening yield curve. Here is how this whole thing builds. When long-term rates stay pinned high, analysts discount future cash flows way more aggressively, so stock valuations compress. It also means your mortgage rate just refuses to drop back down to 3%, making housing unaffordable. Corporate credit tightens up, risk appetite falls off a cliff, and ultimately economic growth slows down across the board. Finally, we arrive at part 5, the truth about global liquidity. You really have to wonder, why isn't this front page news every single day? Mostly because traditional media chooses to chase highly clickable headlines about AI instead. Actually explaining how Japanese institutions are reallocating capital takes a lot of patience and nuance. But listen, the real threat isn't the loud news that the market has already priced in. The real threat, hiding right in plain sight, is the fact that the absolute cheapest source of global liquidity for the past 30 years, the literal oxygen in the markets, is simply gone. The cost of money is changing everywhere. So, I want to leave you with this final vital question to ponder as we wrap up this explainer. If the largest foreign holder of U.S. debt decides to take a step back, and all that easy global liquidity just dries up, what happens to the foundation of our entire economy? It's the most important dynamic to watch right now, and it changes absolutely everything. Thank you so much for joining me, and make sure you keep your eyes on the real threats out there.